technologies.
Lovely. Thank you very much. Ms. Taylor.
Hi, I'm Chris Taylor. I work for a company called Everledger, and I'm the Chief Operating Officer of the company.
Thank you.
My name is Martin Walker. I'm Director for Banking and Finance at the Centre for Evidence-Based Management, but I also have a very long history in IT management in many banks, written several papers about blockchain, work for a blockchain company and still involved in blockchain projects.
Thank you.
Hi, I'm Ryan Zagone. I'm from a company called Ripple. We specialize in cross-border payments for financial institutions. I was our head of research initially, and now I'm focused on policy work.
Lovely. Well, thank you all very much indeed for giving up your time this morning, and I'm hoping that this is an opportunity for all of you to show off your extensive knowledge and for all of us to gain some knowledge to help us with the inquiry. So I want to start perhaps just with a very general question. I should say that where we can, we'll try to perhaps direct questions to particular panel members, so don't feel you have to answer every question, but on the other hand, if there are things that you want to contribute to a question that's been asked, then please do feel free to jump in. And I want to perhaps start, I think, with a question that hopefully all of you could answer, which is, how does blockchain differ from traditional databases? Why is it that people have got excited about blockchain? Who'd like to kick off? Come on. Yeah, absolutely.
Blockchain as a technology allows us to validate, store, and synchronize information across many different parties more securely and more efficiently than we have been before. So we're looking at reviewing information for its accuracy and authenticity. We're storing it in a way that can't be tampered with, and we're synchronizing it across many different parties, even globally. So this validating, storing, and synchronizing information has many different use cases. There's a lot of hype around the technology right now. People recognize that this type of capability allows us to be much more efficient in how businesses or our commerce can be conducted. There's lots of use cases for that. It's very general tech. So we're seeing, even on the panel today, many different use cases. Ripple's focused on using this technology to improve cross-border payments.
Yep.
So like the payment space is quite outdated now. If you do a cross-border payment, it usually takes about 4 days, 2 to 4 days, to send a payment overseas. At Ripple, with this tech, we're doing it in 4 seconds.
Gosh.
So it's a material increase. And the key focus from banks has been financial inclusion. So Santander is one of our key partners. They've launched a remittance product, so real-time remittances instead of 4 days, and corporate payments, so real-time corporate payments between different countries.
Yeah. Thank you. Mr. Walker.
I think one of the key things about blockchain to where it's reached now is it really isn't a generic technology at all. Starting from the original Bitcoin blockchain, which was a package of existing technologies designed to solve one very specific problem, as people have tried to take that technology and apply it, it's mutated incredibly. People have dropped, to actually make it work in the real world, people have actually dropped varying degrees, many of the features of the original blockchain, simply because it was never designed to be a generic technology.
Okay. Ms. Taylor.
I think some of the key elements of blockchain technology is I think Ryan touched on it earlier, is the way that the information in the ledger is made immutable from the way that the technology is constructed. So in a traditional database, records can be edited quite easily, either by an administrator or by other people who have access to the database. In a blockchain, information cannot be edited. It can be appended to, but the original information remains at as a form of record, which makes it a useful tool when trying to trace back the history of transactions related to that database, whether that's related to assets, whether that's related to currencies and other kinds of transactions.
Kotsialou.
And on these nice features, I would add extra that is more difficult to hack because the data are replicated to every node of the network.
Yeah.
And also you can, compared to traditional database, you can add smart contracts on some of the blockchains. So what smart contracts are are extra functionalities that you can add on the top of the foundational record of data. So with these functionalities, you can add extra services. So, for example, on the voting that I'm more expert, you can maintain a list of eligible voters. You can allow counting of encrypted votes, and you can also block the interim results on the voting procedure. And apart from the smart contracts, blockchains allow a percentage of malicious participants to join the network. So even if there is a part of malicious participants, then still the blockchain could work. So in database, this is not true. So if only we have, because it's a centralized application, if this is a malicious participant, then it can just add invalid data in the database.
Okay. And you've met, I'm sure we're going to come back to the voting, particularly relevant to the building you're sitting in now. I mean, you've mentioned, we've heard about payments, we've heard about voting. What other industries are exploring the use of blockchain? I know Everledger have got particular, obviously in your business, is, again, it's a slightly different aspect or use of all of this.
Yeah, so Everledger use a form of blockchain technology which is divorced from the digital currency originations from Bitcoin and other types of digital currency. We've used the blockchain technology in the industry. We've started in the industry of diamonds.
Yeah.
So in order to provide additional transparency into the origination of an asset. So what we do is take the various characteristics of a diamond and we lock those into the ledger, and that record is then immutable, and then that record of that diamond can be traced all the way through from the mine where it originated all the way through to the end consumer and potentially beyond into secondary markets. So the blockchain ledger allows us to capture each step of that asset along its journey through the supply chain. So that can be through trading patterns, through import-export processes, through grading houses. All of that information is gradually building upon the original record of the diamond. And that allows the participants in the supply chain to have greater confidence around the authenticity, existence and attributes and history of those items, which enable our clients to have greater trust in the people they're dealing with. It also enables other participants in the supply chain, such as governments, to have greater confidence about what are crossing their borders. It also provides other participants, such as finance houses and insurers, from identifying if assets have already been financed, for example, or have already been insured, or are already the subject of an insurance claim previously. So it has a high value in the reduction of fraud across the industry.
Yeah. Mr. Walker, I mean, I don't know about others. To what extent is blockchain just sort of a proof of concept rather than implemented technology, or have we now got beyond people wanting it to be proved? It's accepted.
Well, I'm going to repeat my initial point. Blockchain, it's almost meaningless to talk about blockchain as a single technology, because it isn't anymore. In terms of where it's got to, I'll divide it into three broad groups: the good, the bad, and the ugly. The biggest group, where almost all the effort and the resources have actually gone into, is the world of cryptocurrencies, decentralized systems, ICOs, etc.
Yeah.
So this is an area where people can make enormous amounts of money, but there's very little obvious benefit to society, and there's a huge number of red flags it raises around privacy, facilitating crime, even decentralization, where that means there's no one clearly accountable, and we see see blockchain-based businesses which are structured specifically to get around regulations. That's by far the biggest group. The next group I'd call the ugly. Now, the ugly is basically where people have taken the blockchain technology, they've bought into the hype, and they think this is a universal panacea which can solve everything. And it's very interesting to trace back this question of why do people seem to think it could solve everywhere? Because the list of use cases is kind of endless. And you can trace this back to social media to around 2014. Someone published a list and saying you can use blockchain to solve all these problems, no explanation of how or why. And this list has just been passed on from consultancy paper to consultancy paper, and people have tried to fit it. And my fellow panelists have talked a lot about immutability, distribution of data. Many of these things are things you can do with techniques which have existed for years, for decades even. Even some of the most basic concepts like a Merkle tree you might hear about 1979. So distributing data, keeping it consistent, making it tamper-proof, very old techniques. So the ugly is where people try to force in variations of blockchain based on this list which nobody remembers where it comes from to try to actually make it work. The good, which is a much, much smaller group, is basically where people have started with the Bitcoin blockchain, evolved it, dropped most of the features, and actually starting to head towards systems that might actually end up being useful in terms of making data consistent, distribution data, etc. They're ending up looking a lot more like conventional systems that were already around. And the other part of the good, and I say this is by far the smallest section because most things are still in proof of concept, is where blockchain is just being used as a catalyst. People are doing things, digitizing things, where you don't need blockchain to do it, but it's got people's attention on areas which haven't been automated, haven't had much attention in payments and trade finance and areas like that. And it's actually getting people to do one of the hardest things in IT, which is actually to get people to agree on common standards around how you represent data and how you actually process it. Most of the actual problems in applying technology are actually around people and actually getting agreement on things like this. And in some cases, the blockchain dream has been a catalyst towards that.
Okay, thank you. We're going to look at one specific use now. Charlie.
Yes. So, Ryan, can you explain how it is that Ripple has been making use of blockchain?
Yeah, so we focused on cross-border payments, where today, or previously, it was a quite painful process. Cross-border payment would take 2 to 4 days. You wouldn't be able to track that payment, and you didn't know the fees up front. So it wasn't until days later when your funds were delivered that you would find out how much was taken out as a fee, and you essentially went into a black box. You could literally mail a box of cash and have better tracking and certainty than you could sending a payment through a bank. So what we recognized there was a key pain point in cross-border payments that was limiting consumers' use if they were sending money back home. It was also became a key limit to economic growth for small corporates that were looking to start to grow internationally, like importing raw materials or exporting goods. They couldn't manage this very complex 4-day payment cycle. So most of them backed away from international growth and would just focus domestically. So we took the technology and we built 2 products with it. First is a product that allows banks to do real-time cross-border payments. So 4 seconds instead of the 4 days.
Yep.
We guarantee the fee up front, so the sender knows exactly how much the fee will be. And it has real-time tracking, so they can track it all the way through. So that allows banks to connect to currencies they're using today. It's a pre-funded model, meaning the banks will have, there's 2 parts to a payment. You have to be able to connect, and you have to have that foreign currency. So our first product just allows banks to connect, and the bank already has the foreign currency. There's a key problem in payments that we have that no one solved, and it's how to connect to currencies that are foreign or exotic or don't have a very high volume. So say like your tier 2 or tier 3 currencies. So like an example would be, say, Mexican peso to Korean won. There's payment demand, but it's very hard to find a market between those 2 currencies. So what we've taken is a second product that uses the digital currency, or digital asset. And we've used that as a bridge to connect these hard-to-reach currencies.
That's XRP. So using XRP is effectively the translation mechanism.
Exactly. It becomes this bridge. It's the same technology that underpins Bitcoin, the currency. but we're not using it as a currency here. We're not. The Bitcoin model would say replace the euro or the pound or the US dollar, and you use Bitcoin to buy your coffee. In our model, we take that same tech and we connect existing currencies together more efficiently.
So in other words, let me understand that. So if you like, Bitcoin is more Android and what you're doing is more Apple, a sort of centralized controlled ecosystem.
I've never thought of it in those terms. So as XRP, it's not controlled by us. It wasn't issued by our company. That's an open source platform. We're just making use of this open source technology, and we've built that into our product. I think there is a tight correlation between us and the currency, just as the market has begun to understand it. But in reality, it's open source. We as a company could go away, and that technology would continue to exist.
So rather than being a kind of separate currency, really what you're doing is a kind of payment bridge,
Exactly.
which I guess is you call RippleNet. And how much money is being transferred through RippleNet today, and what has the expansion rate been over the last year?
Yeah, so we've signed over 120 financial institutions to the network for them to enable real-time payments. The focus is on remittances, which are now live. We have several banks that have launched remittance services, and corporate payments, particularly for payments that need to be made immediately or down to the cent to control exactly what gets delivered. So this fills a product gap that most banks had. We have 120 financial institutions using it. We've had a couple clients send around $1 billion thus far, mostly corporate payments. And then we have some smaller value numbers around the remittances. Those products are just now launching.
And also, let's just look briefly at the risk. Let's say you've got a transaction going through, as you say, from, say, pesos to Korean won. It goes into XRP and then goes into Korean won at the other end. There concerns have been raised that what happens if the value of XRP was to catastrophically change while that's happening. How do you mitigate that risk?
So the payment would go into XRP as a bridge and out of it immediately. So it's not exposed to XRP price before or after the payment. It's just in those 2 or 3 seconds that it gets converted through. So the price volatility only really matters in the exact few seconds you're making the payment. Now, an important point to make, so 2 different products. One product is banks are using today, that's live, that does not use XRP. So banks are connecting with their own existing accounts. We have a second product we're testing now. It's in pilot with Western Union, MoneyGram, and some others that uses XRP. That's not a live product, though. So the banks we see on their network are not using XRP right now. We're looking down the road of how they can expand their reach through XRP.
And more generally, how do you think blockchain can sort of change financial services?
We're seeing an ability to leverage that tech to better meet customer needs. So on the remittance and corporate side, for ability to synchronize data. So I'm doing this much more efficiently and at much less cost. Our early models have found banks are saving about 60% on the cost of a payment by using our tech. So it's a material reduction that starts to open the market to new types of payments, like very small payments, lower cost, more efficiency.
And are there any other projects other companies have invested in that you think have got real potential outside what you're doing?
Yeah, we see use cases around securities trading, making that more efficient, trade finance, and digital identity as some of the other key solutions in the market. We're not working on those directly or at all, but there are other companies that does seem very promising.
So it could transform letters of credit and that sort of stuff?
Exactly.
How do you think it could do that?
With the ability to be more transparent, you can have more transparency in these systems. You'd have more certainty about who owns what type of invoice or where that payment or transaction is in the flow. Trade finance processes usually take several days. So it kind of goes into a black box, kind of like payments. We don't really know where the tracking is. This gives you much more visibility to those use cases.
And finally, how do you stop crooks hacking the system and running off with all the money?
Yeah, so we've taken this tech and specialized it for enterprise use. So we're a vendor to that financial institution. That financial institution is regulated. They have requirements for the type of vendors they use. So they audit our systems. They audit our solutions. We do third-party audits as well to ensure that it's enterprise-grade technology that we're delivering.
Thank you. Alistair.
Martin, if I could turn to you on this blockchain and financial institutions, and I heard what you said in your opening earlier in your opening statements about the good, the bad, and the ugly.
Yeah.
So, I mean, my first question is, do you think blockchain will generate solutions to the inefficiencies in the financial sector as its supporters are claiming?
Well, I think it'd be useful to actually just take a step back and actually just talk a little bit about Ripple, just to actually put that into a bit of context, and we can talk about the potential efficiencies in the financial sector. Now, one of the things that commonly happens with anything around the blockchain space for people who are trying to sell it is not really quantifying stuff, painting a big picture, throwing out a metric which doesn't actually necessarily be meaningful. So if you look, for instance, at payments, core part of payments is actually just sending a message to tell a bank to do something. And it's very interesting actually looking at one of the Ripple models, and which has been used in a lot of that 120, which have actually been just pilots, proof of concepts. Ordinarily, a bank would send a SWIFT message to another bank telling it to make a payment from its account. Now, what I've actually seen on some of the Ripple demonstrations is that we bring along the Ripple technology, you send the same message out of your infrastructure, goes into Ripple, and then it comes out the other side. So you've just added an extra layer of complexity, but with tracking. Now, when it comes to the tracking, tracking, you already have the Swift network have actually added tracking. And the hard thing about tracking payments is actually getting the people involved in payments to actually update the status. So simply having a blockchain doesn't actually get people to update the status of where the payment is. And if you also look at the idea of using a cryptocurrency as a crossing currency, now I've worked in the FX area. I've worked on the operational side. I've worked on the technology side. You have the concept of crossing currency to deal with that scenario where there's lack of liquidity. The common crossing currency is the US dollar. Now, the dollar as a crossing currency has a lot of advantages. A large proportion of world trade is denominated in dollars, financing, etc. So it has liquidity against every currency, and it is relatively stable. Putting a cryptocurrency, and the Ripple is a cryptocurrency that can move dramatically, even in 3 seconds, is highly problematic. Putting a cryptocurrency into there. And also, even if you are in the scenario for, I think, from the new products from Ripple, you need someone to provide the liquidity to be willing to trade, to change into and out of Ripple. And holding Ripple, a currency which has seen its price drop 80% and then back up 100% in the course of the last 2 months, is just not credible. Yeah. So putting cryptocurrencies into the financial sector is a huge source of risk. And what happens if the liquidity dries up? We saw in the financial crisis that even dollar liquidity can dry up. And we had the Federal Reserve provided swap facilities to all the main central banks to do that. Who is going to actually do that if we actually get payments or currency flows using the Ripple system? Who is going to actually provide liquidity in that scenario? So that's Ripple. Now, most of my background is in banking technology, but I also spent several years working in capital markets. I also spent several years in the operations department of HSBC, where I built an MI system which actually, this is trade processing, and it actually collected all the things that cause the costs and the inefficiencies, which is basically where people are involved in the processing of a trade. So we could clearly see from the data what are the key factors that actually made something more expensive to process to another. And the biggest factor was simply that if you had 2 parties trading with each other and they booked the trade separately into their own systems rather than they do it on an electronic platform, that was the biggest single cause of inefficiencies all the way down the trade processing stack. So when I started getting involved in blockchain in HSBC, one of the things I actually did was actually I looked across the whole trade processing area. I had this set of data. I had the correlations between the factors that cause the inefficiencies, and I had to base it on some model of blockchain, which was actually kind of the variation of the Bitcoin blockchain. And everywhere I looked, it actually caused an added layer of complexity. Now, there are some specific scenarios in my specialised area, which is capital markets, where there is scope for a something to actually improve the way trade's processed. So this is something I've touched on before, but it's a very common theme of how do you agree between all the relevant parties, this is the trade model, this is how we're going to process it, get consensus at the very beginning, and getting consensus at the very beginning is the most important factor I've seen to use in my statistical analysis to actually getting rid of the inefficiencies. And it's quite interesting, having looked at quite a few of the blockchain proof of concepts. They make, in particularly in the capital markets area, they make very big assumptions. They make assumptions like you have consensus at the beginning, you have agreement on the trade. So you assume away the biggest problem.
Yeah.
They assume things like we have cash which everyone accepts on the ledger which I can exchange. And I've had a couple of papers published on cash on ledger, and it's very problematic representing real world cash on a ledger because you end up with all kinds of credit and market risk. So there is a scope for for a better consensus mechanism, both between the parties involved, but also if you look inside a bank, particularly an investment bank, you see many systems processing the same data, often doing the same kind of processing, and many systems with their own different models and way of processing can end up in inconsistencies.
So even though it increases complexity, it seems to reduce cost, but you don't think it reduces risk?
No, I don't think it increases cost.
It reduces cost, I said?
No, it doesn't.
Okay.
There's potential for something...
So when Goldman say they can save 30% and Ryan said they could save 60%, that's not saving cost?
Well, let me tell you a story about a very large...
Brief story.
Very brief story, sorry. Very large...
People normally start like that, 15 minutes.
I promise.
Once upon a time.
This will be a very, very brief story.
Yeah.
Very large consultancy did analysis on cost savings. Came up with huge numbers, billions. There's actually quite a lot of papers like this. How did they do it? Well, they went to the senior management of various banks and they asked them, how much do you think you'll save by rolling out blockchain? Now, two problems with this. Most people still don't understand blockchain. Most people still don't understand what a relational database is. The second problem is, part of the problem, the complexity in the banks, is you often know the big number, but you don't actually know the cost drivers. If you actually had a clear picture of where the costs are coming from, you could actually just solve a lot of reduce a lot of costs by just getting the basics right.
Which is your point in the good. It's made people analyse their cost base and
yes,
and rethink how they do things. So, are there any? Are you seeing any benefits from financial services, stroke institutions from blockchain? I'm leaving cryptocurrencies to one side.
And I think we really do have to put cryptocurrencies to one side. They're very special. I think it's, in terms of demonstrable benefits, little to nothing.
Okay.
There's this big problem in the blockchain world of actually confusing could with is.
Yeah.
Huge problem.
So you've seen blockchain solutions as a fad, and investments in them really not worthwhile?
Well, here's the thing. So I work for the Centre. I work for the Centre for Evidence-Based Management. Our mission, we're a non-profit international organisation, is to actually try to improve the quality of decisions that managers make.
Yeah.
And this boils down to common sense of you're trying to solve a problem. What is the problem? Is it a real problem? I've got a solution for the problem. Do I have any evidence it works? Have I actually looked at alternatives? Have I baselined this solution against other things? Now, all that it takes to make a credible idea, sometimes a good idea, into a fad is that people just switch off their brains, stop thinking, stop asking questions, and start believing. So even things that can be beneficial have to get turned into fads. And in over 20 years in and around the banking sector, blockchain has become a fad, and fads can be very destructive, but it is a series of many fads I have seen in banking. Over and over again, there have been these magic wand, pixie dust things come along, whether it's the way you write software, where you write software, how you write software, over and over again. And if 10% of what I've heard in my banking career had come true, we would have the most amazing banks that run their infrastructure for £1 a week. There have been no problems. But unfortunately, we have just had fad after fad after fad because there is still this chasm between the management and the technology. Management in banks still don't understand technology very well. There's a lot of people in technology, even in banks, who do not understand the business.
So last question in that case. So what, if any, risk do you see to the banking system through this? I mean, obviously, we've had bubbles in the past. Is this a bubble that people will come to their senses? And is it just hitting the profit and loss account, or is it something more serious than that? Now, this again comes to, you can turn anything into a fad. And there are elements in the various blockchain-related technologies, there are elements of things which are actually quite sensible, and if you actually didn't look at it in fad-like eyes and were critical, you can potentially get some benefit there. But the amount actually getting spent on the banks on blockchain-type proof of concept parts, it's actually still a relatively small part of the IT budget. Yeah, good.
So most money is still getting spent on regulatory change. Unfortunately, though, it is a distraction from actually looking at getting some of the basics right. It's also a negative thing about blockchain as a fad, as opposed to blockchain underlying family of technologies, some of which are quite interesting, is it's actually in many ways blocking out genuine innovation. So genuine innovation, you need to be analytical, you need to understand the problem, you need to be imaginative. Genuine innovation is hard. We've created what one of my former colleagues described as innovation theatre. Every bank has created an innovation team, many of which have very smart people in them, actually trying to do real stuff. But if you want to be seen to be innovative, it's really easy now. Any problem, I'll solve it with blockchain. I'll do a proof of concept. Doesn't matter if it never goes anywhere. I've ticked the box. I'm now innovative.
Thank you very much.
So this distraction, I think, is the worrying thing.
Thank you.
Mr. Zagone, we're going to come back to you, so you will absolutely have an opportunity to answer some of the points that have been raised. So do not fear on that score. But we're going to talk about, I think, Everledger now. Wes.
To Mr. Taylor, most of these questions will be directed to you, obviously. Can you begin just by explaining how Everledger's made use of blockchain and what the key features of the services offered by Everledger are?
So we use as I mentioned before, we don't use a public blockchain. We don't use Bitcoin or Ethereum, those kind of public blockchains. We use permissioned ledgers. So a Bitcoin or Ethereum blockchain are open access to anyone, and information on transactions on those networks are open to all the participants on those networks. What permission ledgers do is apply some level of permission, if you like, to join the network. So there's control on who can join the network to ensure that the data and the transactions on that network are from parties that are trusted to participate on that particular network. So on our permission ledger, we capture the characteristics of high-value assets. So, for an example, the example that we've started with is diamonds. So we capture the external facets of the asset, which could be the dimensions, it can be the result of a gemologist grading report. It can be anything to do with the source of that item, or it can be anything to do with the lifetime journey of that asset. So it can be, for example, a change of ownership, as simple as that. And we capture all the aspects of that asset and all of the transactions along the journey of that asset. And that can be ultimately of value to the participants in the supply chain of those assets to have a greater trust around the source and the characteristics and the credibility and the authenticity of those assets. And it can be also an ultimate value to the end consumer. So more and more the end consumer is looking for a story around the assets that they purchase, particularly around jewellery and diamonds. And they want to know that, they would like to know that where it's from, how it came to be in their possession. Because generally, if you're talking about an engagement ring or a wedding ring, then that's part of the story of a particular couple of people. And the jewellery item or the history of that can add to that story and become part of that event. So consumers are more and more looking for that. They're also more and more interested in the ethical nature of the way that these items were sourced or manufactured. And we capture the ethical certifications where those are available to associate those with particular assets, so that companies and end consumers that are interested in ethical items or sustainability can also have a view into that information and have a window into the aspects of that particular asset to make sure it aligns with their goals when they're purchasing something. And regulation is more and more pointing in that direction as well. In terms of companies now have to report the extent to which the goods that they are retailing have been sourced in an ethical manner. So from a retailer perspective, that kind of information is becoming more and more important as well.
So how do you ensure the accuracy of the information that's going into the database to ensure that it's giving your customers or the customers a reliable picture?
So it's the same as any system. It's garbage in, garbage out. So you've got to make sure that the participants that you're allowing to contribute onto the network are trustworthy. So at the moment, or historically, consumers and procurers were trusting the next party down in the supply chain to make sure that to trust that what they were providing had the right background and the right provenance. And now, if you have multiple instances of the journey of that asset, then you can be more confident that that asset is authentic. We also take advantage of external companies that can come in and audit methods and processes. And historically, that information was lost at a particular point in time when a transaction had been completed. And now we can capture all of that information along the journey of the asset until it gets to the person who's interested.
And who are the main stakeholders for this?
So we're working with all types of participant in the diamond supply chain, from mining companies through traders, through diamond manufacturers, jewellery manufacturers, who want to give their customers more confidence and more history around the assets that they're selling, or the jewellery pieces that they're selling. Also working with grading houses and audit and compliance organisations as well.
I guess one of the key questions is, what makes blockchain the right technology for what you're doing? Is it particularly innovative? Are there kind of other ways than it's just a database? These are sorts of questions that...
These are common questions. Yeah. So Martin mentioned that a lot of these technologies have been around for ages, but he's right in some cases. Right, blockchain doesn't solve everything. It doesn't solve entirely problems that couldn't be solved in other ways. But we believe blockchain solves the problems that we're solving in a better way than traditional database technology can provide. So distributed databases have been around for some time, for example. However, they have been more traditionally deployed in where the participants on the network already trust each other. And a distributed ledger allows participants to transact who don't actually trust each other to share their data. And the distributed ledger technology is developing in such a way that you can share as much information or as little information on the network related to a particular transaction or a particular asset as you wish, as is predetermined.
Mm-hmm. In addition to the applications that you've already mentioned, Everledger's identified use of blockchain in law enforcement. Could you just tell the committee a bit more, about what you're doing in that space?
Yeah. So so if you think about insurance on a diamond, for example, and that diamond is stolen, at the moment, provided that theft is proven, then the insurance company will pay out on that diamond, and that diamond will disappear and probably resurface somewhere, either on a secondary digital marketplace or through unscrupulous people dealing in second-hand goods. If as by the use of our technology, we can identify assets that have been previously the subject of an insured loss. So we can help law enforcement to identify where assets are resurfacing into the mainstream public arena, and help not to prevent the crime, but the more that this technology is used, the more that people realise that these kind of crimes might be caught, and that hopefully will be a deterrent.
And what's the appetite or interest been from law enforcement agencies, either here or around the world?
Law enforcement are, as everyone is at the moment, quite interested in blockchain. So wherever we can help make their life easier, then they're interested in talking to us.
Thank you. Simon.
Thank you, Chair. Dr. Kotsialou, my questions are on blockchain and voting, and thank you for your very helpful written evidence on this. Can you just talk the committee through how blockchain technology can be used in political elections?
Mm-hmm. I think at the moment it's a bit too early to talk about national elections, for example, because national elections are of a high risk of being attacked, and there are still some security issues in online voting in order to allow this to happen. For example, then blockchain voting systems, they might use the blockchain technology, but not in its full extent. For example, they could store only the final result on the blockchain, so you can have a permanent record of the final result, but then this does not guarantee that the votes have not been altered before it will go on the blockchain. A second thing is that at the moment it might be a bit technically advanced for the average person to download the blockchain voting application in the computer. However, even if this is the case, we could fix that by entering another interface, for example, another website that would be linked in the blockchain system. But if this happened, then we need to make sure that these other websites are secure, because there could be viruses on these interfaces that could alter the votes before you enter the blockchain application. And third, you could also have As I mentioned before, if the majority of the validators are malicious, they could add fake nodes in the blockchain. But then the rest of the validators, the honest ones, they could go back to the last, let's say, healthy block, and they could start a hard fork, so they could start mining from the last healthy block. So as soon as we would be able to see that two forks are being created, then at least you know that an attack has happened. So it can help also to identify an attack, blockchain technology. Now, okay, that was also the risks in online voting because, yeah, wouldn't allow political elections. However, yeah, it.
So, what are the advantages, if you like? I mean, yes, that sounds quite concerning to me.
Okay, keeping a permanent records in general of the votes, the uses of smart contracts, because you can add extra applications on the blockchain. As I mentioned before, you can maintain a list of the eligible voters, so you can check using smart contracts if a person that is about to vote is the eligible one.
So fraud is a big advantage that you can.
Allow encrypted votes to be counted, so you can encrypt first the votes, put them on the blockchain, and then counting. And also blocking the interim results, because I think there are cases also that interim results are not very desirable. And apart from that, it can increase participation in the general election process, because more people could be able to see what votes have been recorded, encrypted votes. They can take part in the counting process by just, if you are able to see what votes are encrypted and then count it by yourself if you want. But this is also depends all on the features that you want to have in your application. Because, for example, you might be voting for a small scale or within a company where the votes are public. So then in these types of voting, we don't have the problem of keeping the privacy of people.
And that leads me on, actually, to the issue of shareholder voting, because obviously that's the other type of voting which might conceivably benefit from this. Are you aware of any firms that are currently using blockchain or are considering using blockchain for shareholder votes?
So at the moment, the project we're having in King's College with a collaboration with the University of Surrey, there are two parts involved, and the first part is that we are working with Crowdcube, which is the largest equity crowdfunding in the UK. So with Crowdcube, we are trying now to minimize the administration burden in the company. And also we are thinking to create a platform where you can have a share registration and a rights management platform by using smart contracts. So that means that a shareholder, by using this platform, would be able to perform certain actions according to what kind of shares each shareholder has. And also on the top of that, we would also add a weighted voting system where the power of the vote of each shareholder will depend on the number of the shares that each person has.
How far away do you think we are from that kind of technology being used by, say, Barclays for its AGM or whatever?
You mean in banks?
Yeah, well, no, just any company, any firm, which, a large listed company which was having a AGM, and obviously we all know there are real issues around trying to increase shareholder participation and control over these companies. How far away are we from that becoming a practical, viable reality?
First of all, I think this is the least that can happen with this technology, so to minimizing administration burden. Our project is probably one of the first, and it started 2017. So in a chronological timetable, I guess I would say at most 5 years, if you can see this happening.
And how would you combat? I mean, obviously, we know that there are both individual and state-sponsored hacking, and we've I think seen over the last couple of years the sheer extent of, say, the Russian state's ability to try and disrupt activity for malign purposes, and that's quite apart from the criminal elements you might choose to do so. How would you combat that? How can you, if you like, future-proof this technology so you're one step ahead?
So again, you're asking about national elections, right?
Well, potentially, but also, I mean, they could. The scope for disruption is not limited to national elections. It could be financial transactions as well.
So, in terms of security that blockchain can add in general, it has to do with the data replication. So, so if they are replicated in all the nodes of the network, then it's harder to change. And it's also the data validation. So the rules that the nodes follow in order to validate votes or any other transaction, these are all public. So everyone can check what these rules are, and everyone can check that the transactions in the block have been validated with the correct way. And in general, the more decentralized you make a system, the more trusted it will be from your clients as well.
Yes, it's whether that decentralisation is an advantage or a disadvantage.
So, for example, for a private institution, needs to find a balance between having the control of the company, but also gaining the trust of the clients. So they have to decentralize enough to be trusted and transparent by the clients.
Finally, you mentioned in your evidence about the fact that the House of Commons could benefit, quote-unquote, immediately for introducing electronic voting. Now, I have some concerns about that because I think there are advantages to the lobby system, particularly me as a very humble backbencher getting access to ministers. But nonetheless, could you just talk us through how that would work?
I believe that one of the simple use cases of online voting would be in the Parliament, because it's known that you spend a lot of hours of queuing and voting in laws. So if there was an online tablet that you can just vote in each law, I think it would be, at least it would minimize administration burden. So that's one of the main benefits in the meantime. And also, correct me if I'm wrong, but I think that you need to be in the Parliament in 1 or 2 days per week. So that might cause problem for people that they come from north.
Tell me about it. There's also an issue, actually, around, for example, we've been talking about how female MPs could ever end up taking maternity leave in a way which doesn't count them out of voting. I suppose there is potential in that.
Exactly. So, one of the advantages is that then you could use the Wi-Fi and intranet Wi-Fi of the Parliament in order to make it more secure. The other reason that it's a more simpler case is that the votes, I think, are public, so we don't have to work on keeping the secrecy of the ballots. And we can add also to back this up with a blockchain technology for keeping a permanent record of the votes. But adding also blockchain, let's say for the online voting system within the Parliament, could also enable the use of smart contracts. So that means that on the top of that you could do other applications as well. So for example, you could trigger an automatically implementation of a law, given that this law could be deployed in an automatic and computational way. So, yeah.
Thank you very much indeed.
You're welcome. Fascinating. Thank you. Krishnara.
Thank you. I've got some supplementary questions off the back of Wes's question. So, Mr. Taylor, on your website it says you mentioned that there's $2 billion annually lost just in the jewellery trade due to insurance fraud. Yep. Have you got some estimates of how much would be saved through the use of blockchain technology in the kind of work you're doing, and its implications for the wider insurance market?
Excuse me. So there are, well, I don't have figures, but I can provide some areas where cost savings and other savings might come from. So, I explained a little briefly about how assets that have been stolen can subsequently be identified and then potentially repatriated to their owner, which would reduce the cost of fraud to insurers. There is also a lot of work happening in the insurance industry on efficiency as well. So there are applications of blockchain which would help in this area through the use of smart contracts, for example. So smart contracts enable greater degrees of automation of processes. So smart contracts can trigger certain events when certain criteria are met. So, for example, if a claim was outstanding in an insurance company, and all that was waiting for that insurance claim to be approved and paid was a police report, you could automatically have that police report fed in through the network from the law enforcement agency, and that then would trigger a payment or an approval or an internal review point. This saving some time and administrative burden.
Okay, thank you. And how have you done any assessments internally of the work you're doing and what costs it saves by way of fraud? Is there any? Have you got any sense of what you've managed to prevent happening? I know it's difficult to do, but some idea of that. And also, is there a lot of interest from the wider insurance market in what you're doing?
We haven't done any work as yet to understand the extent of the savings. I'm sorry, what was the other part of your question?
Is there wider interest from the insurance sector in the advantages, benefits of using technology like this, and looking at some of the claims you're making and what it could generate for them in a positive way?
Yeah, so insurance is very much about insuring objects. So if you can, our technology allows objects to be tracked and traced a lot more easily. So whether that's in a consumer insurance application or whether it's in business insurance, then there's a lot of money lost to insurance claims from business to business.
But have you had approaches from insurance companies to learn from what you're doing and looking at how it can be applied?
Yes, we're working with a number of large insurance companies.
Such as?
They're under NDA, so I can't mention names.
And what about stolen assets? Is there application? I mean, you mentioned the origin of diamonds. Yeah. Can you see applications for what you're doing for stolen assets, particularly in conflict zones where it's being, assets from museums and so on, where they're being moved around? Is there scope for finding a way of secure, recording the origin using blockchain? Obviously, there are records, but let's take war zones where records get destroyed, and then it's very hard to find the origin of those assets.
Yeah, so there's a specific application that in the diamond industry around the Kimberley process. So the Kimberley process came into force about 15 years ago from countries around the world, 54 member countries, the EU being counted as one country, who have agreed to trade diamonds only on the production of a certification of those diamonds being conflict-free. So conflict-free means that, in that context, means that the money coming, the money from those transactions is not going towards financing rebel causes and anti-government activity, also known as blood diamonds, is the way it's known better. So that process has worked really well. It's eradicated a lot of conflict minerals and diamonds. However, it's still paper-based. Yeah. So by adding a blockchain ledger to that process, you can enable a more certifiable history of where those diamonds are coming from, or where those minerals or other elements are coming from, to make sure they're not from conflict zones or countries that might be on restricted lists and those kind of.
And are you aware, or any of you aware of other areas where blockchain is proving to be useful for tracking supply chain? Clothing, for instance. I have a strong interest in the trading and ethical or non-ethical trading of garments, because, as you know, in a number of countries, the unethical practices has led to thousands of people being killed. Is there scope for that? I was quite struck by Mr. Walker's input earlier on about the limitations of this technology. So perhaps we can have an interaction between the two.
Wherever you have any kind of thing where you're trying to track the supply chain, identify provenance of a physical object, the recurring problem, no matter what technology you use, is actually keeping the data record linked to the physical object. And ultimately, you're talking about the physical world.
Yeah.
Now, I think in Everledger you etch an ID on the diamonds? Or?
So every diamond is unique, which enables us to capture the uniqueness of that diamond, and that enables us to track individually every asset that moves through the supply chain. There's other ways so for other asset classes, then you can capture a uniqueness of those assets as well.
Yes, I think that's the real problem, is actually keeping that link between the record and the real thing at such a level where anyone is ever going to check. I mean, are you going to go, when you go into a clothes shop or Sainsbury's or wherever, and actually scan this and actually check every link in the chain?
Yeah,
and
you can now. You can with barcodes. You can use your smartphone, to check what. So my question is not necessarily what the limitations are, but is it possible?
But the thing is, you're relying on the reputation of who you're buying from.
Yes.
That the system that's been put in place is reputable. You're also relying ultimately on the physical world that someone has actually performed an audit of the process and made sure the link between the data and the physical is always there.
That's right. So that's what I'm getting at, which is there scope for that to happen? So let's take companies that have had have huge reputational damage because of the garments industry accident in Dhaka, where over 1,100 people were killed needlessly. Multinationals, Western multinationals. So they could potentially invest in technology to help them, because I don't think there'd be any shortage of enthusiasm for providing the physical information of where the supply chain is in order to make use of the technology, because consumers want to know increasingly what they're purchasing. At the moment, they're flying blind. When they're going to a shop, even if they're willing to purchase products that have an ethical supply chain, it's quite hard to do that.
The challenge why I think you still need people, you still need auditing, you still need trust, is because there are many, many stages in that supply chain, each of which some kind of fraudulent activity, the labels could be swapped, i.e. the link between the physical and the data.
But if there is the will to do it through the supply chain of a company like Tesco's or M&S,
that's the thing.
You could see it happening, could you?
That's the thing. I think the key thing you've touched on is the will to do it and the trust in companies to do that.
Sure.
The technology solution is almost immaterial, whether you use a database or whether you use blockchain. It's the will to do that. It's the process around that to make sure that that's actually happening.
But you could see a situation where circumstances where in some cases, I'm just trying to get at where the potential might be there, even if, and I understand your cynicism, and I think it's right for us to be sceptical and look at the risks. But if there is potential for technology to be combined with the will of a company to do that, they could.
There's definitely potential for the technology, but again, the question is, which technology, and how do you make a baseline decision around which is the most appropriate technology? Again, it has to exist in the context of trust, auditing, etc. Totally agree. It's something that's a great thing to do.
Just one final question, which is in relation. There have been references to the potential for blockchain being useful in terms of the public health records and other. I mean, you've talked about voting, but in service, other public service provision and tax records, things like that. What are the kind of pros and cons? Does anyone want to add to that? Perhaps. Perhaps if you haven't had a chance to contribute on this. No?
You wanted to say, sorry, just after Mr.
Yeah, I was just going to comment on the database comment of Martin. So in a supply chain that you're trying to connect the provenance of items to, you're not going to have multiple companies and participants in that supply chain connecting on the same database. That's not going to happen. They're all competing, and they're all concerned that if customers further up the line know where those items are coming from, then they're just going to get bypassed as a middleman. So you're not going to get people connecting on a database. On a blockchain or distributed ledger network, you can keep the certain details of those transactions hidden, but then you can make transparent the details that are important around the provenance and the ethical nature and the sustainability nature of those.
It could be done.
Sourcing.
John.
Why hasn't house sales been put on the blockchain?
Who's that directed to? Mr. Walker?
Phil.
Okay. For a question back at you, what problem would you be seeking to solve by putting house sales on the blockchain?
I could see a whole heap of problems being solved by doing it, including knowing that my money's actually gone to the person purchasing the house. So, and Mr. Taylor, I understand exactly where you're coming from on diamonds, and just to make sure I am understanding fully, if I'm given access to your system and I'm purchasing a diamond and someone's hacked your system, I would be able to see, as would you, the point at which it's been hacked.
Yes.
And that therefore is a huge advantage if I'm, say, an insurer. So if someone's hacked into your system, then I can see exactly where it's been hacked and I can see what the record was before.
So there's different angles to that question. So when you say hacked, the system can, if the system is penetrated by someone who's not authorised, they can't go back and change the records that are on that database without subsequently knowing that that's happened. I think that's what you're getting at. Yes. Right? Yeah, that's correct.
So that's a big advantage then. Well, if my house, which is a physical asset, is put on the, from King's College, isn't that why the Republic of Georgia is putting all its property on the blockchain at the moment?
Well, the idea of an append-only database, you're only adding data, or what's called a Merkle tree, which is used in blockchains, which is where you link together the records to make tampering evident, it's one of these things that it predates blockchain. You could do it independently. You could have a Merkle chain built into a conventional database. That's why I think we have to keep getting...
Yeah, but the advantage of blockchain, isn't it, is that with blockchain, those who are given access to it can actually access it. Isn't that the big advantage?
It depends.
So there's an element of democracy built into it.
It depends on which model as well. There are so many. There are public blockchains which raise all manner of problems.
But let's come to the Republic of Georgia attempting currently to put their property records on the blockchain.
Okay, I'm aware of this, but yeah, I agree with the advantages that you can access, you can see the whole history, but you cannot change the history. So these are indeed the main advantages.
So when the Co-op supermarkets put origins of fish through an app accessible via the blockchain now, are there any disadvantages?
When we're looking at advantages and disadvantages, you have to look at the type of capabilities that already exist in that country or in that market. So we're looking at Georgia, who's may have challenges to maintaining a database themselves, or we are seeing in other developing countries where consumers...
But Georgia's doing it because they're fearful of cyber attacks from their next-door neighbour, Russia.
We're also seeing this in developing countries where consumers may not trust the government, maybe an unstable government, to keep land titles. So I think there's several examples now where some of these developing countries have created land titles, platforms that are blockchain-based. So even if the government changes, it provides stability to citizens and certainty to citizens that the land that they hold, they still hold that title even if a government or an authority changes.
So, for example, in the Great Lakes of Africa where that's happening.
Exactly. That's not a solution for every market.
No. No one's bitten on a housing market. Healthcare records. NHS health records. If my health records were on a blockchain-based technology, then I could add in any extra information I've got without compromising those records as held by my GP, couldn't I?
You could do that with a conventional system as well.
But the conventional system wouldn't then allow me to use the same system in a competing database system in my local hospital.
So what do you mean by competing database system?
Well, so there's plenty of competing database systems. So you've been very negative here, Mr. Walker. So is there
I'm just
the use of blockchain in healthcare with healthcare records? Am I right in saying that if healthcare records, patients' healthcare records, were put on the blockchain and that was made accessible to each hospital, that patients could turn up at a hospital and have their health records instantly available?
Yeah, I think that would be possible. And also you can add extra facilities where you can, like, different people will have like different permissions to view different data.
Yeah.
So
you could therefore choose to give permission to your dentist to access dental records which currently don't fit into the NHS system. Would that be the case?
Yep.
You could give permission for, say, if you're an MP, the Parliament, or a staff member here, the Parliamentary Health Service, which does health screening, to input those health records into the NHS system as well.
I guess that would be possible as well.
Isn't the reason it's currently not done because it's a manual system? In other words, a doctor is working on one system, a dentist is working on another system, a GP holding the records is working on a third system, Boots the chemist who might take my blood pressure are on their system but nobody else's, my optician's on an additional system. Bringing those together, what is the disadvantage of doing that through blockchain technology for me as a patient? And is there a disadvantage?
I'm not a health expert, but I will say from the financial services sector, there's a similar parallel where banks have their own individual systems that are very siloed. It's hard to communicate. The technology that we've developed is allowing those different systems to synchronize. So there could be a similar parallel in the health industry of very different fragmented systems now talking to each other in a secure, immutable way that could produce many, many benefits as well. I think the question would raise is privacy, making sure that that information remains private and secure only to those that should be accessing.
And presumably, Mr. Taylor, that's a problem that you have to deal with, privacy in terms of ensuring that your system isn't misused in any way.
That's right. So we have to be careful that the different participants on our ledger have only got access to information that they're privileged to have access to. So if that's involving competing companies on the same network, that means to make sure that the transactions that are happening between two parties, the financial details of those are kept between those two parties, and the relevant details around the asset, which could be simply a date and time stamp. This is the point in time at which we had a change of ownership. You may have a location that you might want to share around the network as well. But yes, we have to make sure that
Mr. Zagone, I mean, why aren't you thinking of creating a product for the housing market? Because with the housing market, then there is a quantifiable asset at a fixed location. I could add in, if I chose to, if I wished to sell my house, additional information, I could choose to do so. Mm-hmm. And that then would be part of my sales pitch. But it could be quantifiable information. For example, a system could be put up whereby an insurer quantified the house has been insured. Or the fire service I could pay the fire service to quantify that it's fireproofed. Is there not quite a significant market in this? Not least because there's increasing fraud with people setting up fake internet-based systems so that money's transferred not to the person who's selling the property, but to some criminal somewhere else in the world. Isn't there an advantage when it's fixed assets like that of using blockchain technology in order to develop a much more democratic market?
I agree. So we're focused on payments. In a housing transaction, in a diamond transaction, in a securities transaction, half of the transaction is a payment. So payments become the foundation of your economic system. So we started first with payments since it is foundational, and we've opened, all the technology we use is open source. So other use cases like ensuring the data that's being connected to the payment can easily be built on those platforms as well. We're still in an early day. And the technology and how it's being specialized for different use cases is still in an early day. But we certainly see this vision of much more efficiency and interconnectedness.
A final question to you, Mr. Taylor. Why do you allow, and if not, why don't you allow an NGO that's involved in exposing the whole concept of blood diamonds and that trade, access to your database, i.e. blockchain, in order to democratise the diamond industry and allow a third party who's not a purchaser or a seller or a producer, but an interested third party, to actually also be able to access and feed back in if they think something's wrong? We don't. Well, so we do allow access to third parties who aren't necessarily transacting on the network, such as auditing organisations who may be auditing from a process perspective to make sure the data is going into the network correctly. They may be auditing from an ethical practices perspective, and yes, it could extend very easily to NGOs on a broader scale.
Okay, lovely. Thank you. Catherine.
So in terms of the data on blockchain, it's only as accurate as the data that is being inputted into it. So how do you manage those risks that the data actually being put into blockchain is accurate?
I'm happy to jump in. So from our Ripple net, our network of banks using our system, it's a permissioned network. So it's only the financial institutions that are part of that network. And we have a governance body, or a legal framework around it, so that banks know the type of information to put in, and that they can validate that back and forth between each other to ensure it's accurate before they act on that and move funds.
Okay, and Everledger?
The same, it's a permission network, so the participants on the network have already been screened for.
So there are no anonymous identities, there are no anonymous individuals, or there are no individuals who are hiding behind other identities on blockchain?
It depends on what kind of blockchain you have. In what's called the decentralized public blockchains, there's a very high degree of anonymity. I mean, and this is one of the key things that people have tried to apply blockchain variations of blockchain in the real world. They have thrown away that. They have introduced a central party to actually control access to the blockchain. So a lot of those original features have been thrown away, and it's started to become a lot more like a conventional system in terms of there's a party controlling access, identification of people, security limits, etc. Just to go back to Mann a little, many of the things you talked about in terms of actually making systems talk to each other, the hard bits are actually establishing the protocols for the systems to communicate, establishing the standards about how data is represented, managing the permissioning. These are things you can do with a centralized database, what's called a distributed system, something that's been around for decades. The internet is a distributed system, or some variations of the blockchain. Waving the blockchain magic wand doesn't make these go away and make them any easier.
Okay, so how would you assess the risk then of the accuracy of data and the identification of individuals?
I want to mention.
And would you say that there are bigger risk factors to your industries than in use of blockchain than the data and the identification issues?
So I want to make sure we're being accurate in how we're describing some of the risk in the systems, particularly the open systems like Bitcoin that it is an open source system. It's not anonymous. While you may not know the identity of the person, you can see their account and you can see all a history of all the transactions from that account. So that gives you much more visibility than, say, compared to cash, where you can't track it at all. So there's already, with this open source technology, it gives you much more visibility into the history of records. Law enforcement has become quite smart at tracking that and putting together patterns to identify accounts. So there's already new layers of visibility in here that you don't have with cash and you didn't have with traditional systems. Now, several countries have put in place rules. Japan is a key example here that requires users of those systems, the open systems, to identify all of the individuals using the system in the same way banks have to in other markets. Yeah. They've applied both know your customer requirements and anti-money laundering requirements to those systems. That's working very well there. We've been a proponent of those rules in other countries. Ripple made a recommendation to the G20 to create a framework that requires KYC, anti-money laundering, and consumer protection requirements to exchanges in the virtual currency space. To bring that activity into the regulatory fold and make sure that those risks are contained.
Okay, but if that risk management has been identified within particularly the financial services use of blockchain,
yes,
should it not be applied more widely, and is it not a risk where it is not?
It depends on your use case. So the use cases for financial transactions like payments may differ from a use case like Everledger where you're just tracking the history or movement.
Well, how can you be sure that the person who is initially registering on your blockchain system is not fraudulent in any way or engaged in criminal activity in any way?
It depends on which kind of blockchain.
Yeah.
As I mentioned, most of the ugly to good are permissioned blockchains. There's a central person who is identifying who you are and establishing your level of access. It's not quite right to say that KYC has been introduced on these public blockchains like Bitcoin. What has been introduced is actually on exchanges where real-world money interacts with the blockchain. And when you say it isn't anonymous, the Bitcoin blockchain, you don't know who it is.
Yeah.
And they can create as many accounts as they like. Now, it's great that law enforcement have actually been able to analyse this more and actually uncover wrongdoing, but it's also wrong it was there from the first place. And the new generation of Bitcoins where you have the anonymity are actually built to be even more private, to hide not just who owns what, but even hiding the transactions. It's like Bitcoin was fundamentally flawed from the very beginning from a law enforcement, but we're actually tolerating people building things which have got even more privacy. To what end, other than to actually defy law enforcement and regulation? But there is a big difference between public and private blockchains which are permissioned.
Okay, I mean, another issue that has been identified is potentially cyber attack and hacking, but also taking sort of majority ownership of a blockchain and therefore having the rights to actually amend and adjust details, both past, present and future. I mean, to what extent have you identified that as a risk within your organisations, or more generally within blockchain that then could undermine trust and confidence in your organisations?
I think to Mr. Walker's point, one thing I do agree with him on is it depends on the model of the blockchain you're using, what type of risk percolate there. So we've looked at that very closely in the system that we built for financial institutions. That's been battle tested by the banks and by central banks and regulators themselves before that's gone into production. So last year we ran a proof of concept with Bank of England where they tested the software to enable new capabilities within their own systems. It was a very successful proof of concept, and they've added some of those capabilities into their blueprint for future systems. So we're seeing that these being battle tested and the technology maturing to be enterprise grade. And in that maturity, enterprise grade, so like good for a bank or a corporate to use. So the technology is in that maturity phase. It's a very similar cycle we've seen with other technology breakthroughs. And I'll use the automobile as the example. Like the Ford Model T was the first broadly accessible automobile. And there was a lot of hype around that, much like there's a lot of hype around blockchain. The hype being it can solve all of our problems and it'll give us world peace in the process. Like there's a lot of hype right now. It's similar to the Model T when it first came out. But that one design didn't allow us to meet all of the use cases that we saw for the automobile. So it went through a long period of specialization. So there's a wide variety of models specialized for use cases. Your 18-liter to move goods, your minivan to move your family, your sports car to move fast. Each of them have different risk parameters and mitigants to make sure they're safe. They're all specialized. We're in that specialization process now for blockchain. So taking it and modifying it, specializing it per these different use cases.
But they are regulated. All of those different car models are regulated.
I'm sorry, could you?
They're regulated.
In the automobile industry?
Yeah. Safety standards and
it's also a rather strange analogy, given that Ford Model T, it's a car. It moved people around. Ford progressively made them cheaper and cheaper so that they were the car accessible to anyone to buy. Bitcoin blockchain is a very, very strange starting place, this anonymous payment system with this made-up money. So it's...
separation. It shouldn't be. I mean, I think what this session has explored is the separation between blockchain and the currencies. I think probably in the public part of the reason for having this inquiry is being the confusion or the continuing assumption that they're one and the same thing.
No, not at all.
And trying to pull them apart. So the blockchain is a mechanism by which things, assets move around in the same way as a car is a mechanism by which people, goods, move around. And what we're hearing is that the technology, I think what Catherine's getting onto is about the regulation and your point about, Mr. Walker, about we're tolerating these things being set up. I mean, the honest truth is that, and I think this is where the regulations, but it's not a question of tolerating, it's a question of bright people around the world will take advantage of technology, and government and regulators are always going to be playing catch-up, and that's what we see on the internet with the dark web, isn't it?
Well, I think the difference... Okay, the point about the blockchain family of technologies, and I will keep making this point, it's ended up with a very, very diverse family of things, many of which have thrown away almost every feature of the original Bitcoin blockchain. Two different things, especially when you have the permissioned world and you have the non-permissioned world. Now, the thing about almost anything which has a cryptocurrency involved is it raises a lot of red flags right from the very beginning. These had, day one, Bitcoin blockchain raised red flags around the anonymity. The idea of even of a legitimate company which makes money selling cryptocurrencies is actually raises a number of huge red flags by itself in terms of actually a level playing field between investors. So if you were to look at the Ripple example, they have done some very interesting things around payment messaging. But if you look at where their money's come from, They have raised $90 million from venture capital funds, and I have been on both sides of the actual fundraising in terms of they get to see all the finances, they get to see how much revenue are coming from these 120 clients, how much that is actually from doing payments and how much is just from doing experiments and proof of concepts. On the other side, and also most critically, they get a right of ownership in Ripple Labs. On the other side, if you have a cryptocurrency involved, cryptocurrency gives you no rights. So ordinary investors see all these stories about, for instance, Ripple, this fantastic technology, and they go out and buy the cryptocurrency. The cryptocurrency doesn't give you any rights of ownership, doesn't give you any right to actually exchange it with Ripple Labs back for cash, and it's very dubious whether it have any value. So $90 million has been raised from venture capital funds who get to see all the information. In the last 18 months, on the open market, Ripple Labs has made $365 million selling cryptocurrencies, and the vast majority of that was sold via exchanges. So that means ordinary people are buying into cryptocurrencies where there's an associated real story which gives them no rights and does not put them on a level playing field with expert investors.
Well, I think there are two issues. One is I think Catherine wants to pick up on the general regulation point, but Stuart's got specific questions for Ripple as well. I wonder whether, Stuart, you might want to ask your questions now, and we'll come back to the more general regulation point.
Thank you. Just before I get onto the regulatory bit of it, can I just ask Mr. Zagone, why is XRP controlled centrally? And does that central control give Ripple the opportunity to manipulate the XRP price?
That's a common misperception. So XRP is open source, and it was not created by our company. So that existed as an open source technology. We created a company that was interested in modernizing payments and began using that open source tech to do so. So we've taken aspects of that technology and incorporated it into our products. But we didn't create XRP. We as a company could go away tomorrow, and XRP would continue to exist. So what we do have is we do own a significant amount of XRP. It was gifted to us by some of the open source developers that created it. But there's not a direct connection between Ripple, the company, and XRP. I'll give you an example.
No, so I understand that. So if it's controlled centrally, who's it controlled centrally by?
It's not controlled centrally, though. So it's an open source platform that is distributed. So I mean there's multiple different parties that operate that network, that XRP network. We as a private company make use of that open source tech. We contribute to it, but we don't control it.
Okay. Can I just ask briefly, Mr. Walker, when we hear about this decentralized system,
yes,
I'm struggling to see a difference between blockchain and its derivatives and what we used to call decentralized computing and record change tracking about 100 years ago.
I think the key... I'm old. I studied computer science a very long time ago, and one of the courses we studied was called distributed systems.
Indeed.
And many of the features of the blockchain have similarities with distributed systems. Now, the difference when people talk about decentralized, which I think is where the big regulatory red flag comes up, is no one is accountable. And I think that's a very serious problem, particularly if you are linking, well, from consumer protection, from law enforcement, but also if you're linking the existing world financial system into something which is generally decentralized, where no one is in control. And if you look at the ICO phenomena, the International Coin, they have constructed these fascinating legal structures to give the veneer of decentralization, so no one is accountable. Accountability, speaking as someone who used to run IT infrastructure in banks, accountability is critical. There are lots of rules about accountability, and the FCA has a whole chapter on systems and controls, and the Bank of International Settlements have a whole set of guidelines about financial market infrastructure, and so much of that just comes down to accountability.
We'll get back to some of that in a moment, but the point that was made earlier, Mr. Zagone, is that if people buy XRP, a financial asset from Ripple Laboratories, it doesn't entitle them to an ownership stake. It's no right to be converted back into conventional currencies. and it doesn't pay any return. It also seemingly has no purpose. Is that simply to avoid XRP looking like a security or an equity and avoid the necessary regulation?
So XRP is open source. We talked about it a few minutes ago, meaning there's many participants that make use of that technology. There are virtual currency exchanges that do sell it to retail consumers. They do so as either an investment or a payment tool. Those are exchanges not related to Ripple. Wait, I'm sorry. Yes, please. We as a company, we make use of that same open source technology. We don't sell it to retail consumers. So we only sell to institutional market makers and financial institutions. We have a license out of the state of New York to cover that activity, a BIT license. It does not allow us to sell to retail consumers, to you or me. So we sell to institutional parties, and we have a partnership for open market selling as well. But that is not we don't directly sell to you or me,
but
only to financial.
So clearly these things can be bought and sold at exchanges.
They are.
So how many of your institutional partners are exchanges?
Right, so there are exchanges that make use of that open source tech. That's tech not controlled by our company. That existed before our company, outside of our control. We're just leveraging it as a tool. So they are selling it on the market. The other exchanges are.
I'm struggling here.
Could I help?
How do I go and buy an XRP and then sell it in an exchange?
So you would buy it on the exchange, on that virtual currency exchange.
From whom?
From other parties that have XRP. So half the XRP is open in the market at exchanges. You would buy it on that exchange from a party that's looking to sell it. Now, given this dynamic that we as a company make use of this tech in the enterprise space, there's also exchanges selling it in the consumer space, we've called for a global recommendation for licensing of those exchanges to ensure that there's consumer protection, AML, and safety and soundness measures to make sure those exchanges are also safe.
Yes.
I want Stuart to finish the questioning of Mr. Zagone first. Yeah.
So I'm actually going to come to Mr. Walker just on that. So apart from a price rising through the bubble effect, why would anyone buy some of this stuff? From any exchange.
Should I just correct a few things first? There's Ripple the company, Ripple the network, and XRP, which is a currency. XRP, 100 billion XRP were created. Ripple Labs has 60 billion of them, which they sell. The founders took most of the rest. So to say XRP is open source and it's nothing, Ripple Labs controls most of this stuff, and they make very good money selling it. Now, the reason why Ripple sell it via exchanges to the public is 2015, Ripple was prosecuted for, I can't remember, it was anti-money laundering, and they only paid a $700,000 fine, and part of the agreement was they were not allowed to sell XRP directly to the public. But now you have exchanges.
Can I come back?
If there's something factually incorrect in what Mr. Walker's just said, could you just correct it?
I'd be happy to send you the link
we have something in our briefing about the case, but I'd like on the record, the public record, if there's something factually incorrect that should be said, I think you should each have a chance to correct the record, Mr. Zagone.
Thank you. In 2014, the U.S. government did a review of all of our operations and found that in that very early day of the company, in 2013, one of our subsidiaries was not properly registered, and we did not have a sufficient compliance program in place for some of the activity we were doing. We agreed with that assessment. It was a retroactive assessment. We had a settlement agreement on that. We did pay a fine and agreed to put in place a full compliance program. That's a 3 or 4 year agreement. We have done so. We've met all of the requirements of that agreement to date, and we've had no such findings since.
If there's anything incorrect, if after the session either of you want to correct anything that has been said about that, then you're very welcome to write.
I'd like to thank Ryan for that clarification.
Fine.
But there was a settlement made, there was an agreement made, and Ripple Labs is no longer allowed to sell Ripple, the currency, directly to the public.
Okay.
Mr. Zagone, you said there were 120 or so financial institutions with contracts with you.
Yes.
And you also said, if I heard you correctly, that a number had moved or shifted or $1 billion each or so within that process. Is that correct? So big numbers, but small beer in the big picture. If XRP became more commonly used, how do you think governments and regulators would react to a private company centrally controlling a crypto bridging currency? How do you think the international regulators would react to that?
Yes, we've been very involved with regulators to help them to get feedback on how the technology should be developed, to identify risk and mitigate those risks. So that the money that's moving today, let me be clear, are not using XRP. So we have two different solutions. The solution that's live does not use XRP, so that the money being moved today is just fiat currency to fiat currency. Now we're looking at leveraging XRP as a bridge into hard-to-reach currencies. So the hard-to-reach ones where there's not an easy connectivity today. That's been in pilot for about 3 years now. And we've been very slow in that process to make sure that we're checking all the boxes, we're considering all the risk, and we're mitigating those. So we have 6 pilots going on right now that have been quite successful at giving payment companies a reach into new markets. So those are still in pilot. We're still testing those and learning how to make sure we're doing that safely. The currency, to repeat, it's not controlled by Ripple. We have a concentration of ownership, but we do not control that platform. That platform is open source. It existed before our company. We came about and said, hey, we think that's really interesting technology. Let's build a company that leverages it. But we didn't create it and we don't control it. So there's a separation there. We could go away. We could fail and go away tomorrow. And XRP and that ledger would still exist.
But if your pilot's work comes to fruition, that XRP becomes this bridging currency, for that to work in the way the dollar did for decades, it would have to be viewed as a reliable currency. How far away is XRP from being viewed as a real reliable currency, even for bridging hard-to-reach real currencies?
Yeah. So we don't consider it a currency internally. We call it a digital asset. The currencies in our system are fiat currencies, US dollars, euros, pounds. And the payments made with using XRP are still in those fiat currencies. But the way that in our pilots, the way that a financial institution would quote that conversion would be through this bridge as an XRP. We call it a liquidity tool or an FX tool, but it's not a currency in that use case there, it's a tool.
Okay, you said it was an asset. So what is it? If I want to swap my Venezuelan currency for an asset and then convert it into my Korean currency, which is the example we've used, is it a stock? Is it an equity? Is it a future? It must be something, otherwise there's no trust in it. What is it? What is the asset? Or is it just hype?
So there's many different categories that we see coming to the market depending on how that technology is used. Like in the US, the IRS, our tax authority, has deemed them assets, just like property. The CFTC is saying some uses of these and some design of these look like commodities. The Securities and Exchange Commissions, some look like securities, particularly the ICOs. So we're seeing, depending on how they're constructed and used, different categories. We expect that conversation to continue as the technology evolves.
Just one final point. Do you have that in black and white, the difference between the different assets that we could have sent to us to understand how some of the regulators are differentiating between them?
Yes.
I think that would be very useful if we could have that.
I'd be happy to send you the guidance, and there's several countries that have been working on this framework, so I'd be happy to share that with you.
That's really where I just wanted to end up finally, actually, on this issue about regulation. And I think, Mr. Zagone, you put your finger up with different regulators treating sort of the assets. We've had a conversation with the SEC about securities or about commodities. And so I really wanted to ask, each member of the panel, I think, Mr. Zagone, you just said you wanted a global recommendation about, was it about the exchanges? Yeah. So perhaps you could just, if there are views in the panel about where you think regulators should go for consumer protection in particular, or alternatively, if you think, frankly, this technology and these assets should have such big red flags that they should not be offered to members of the the public, and I'm talking about perhaps non-sophisticated investors. It's slightly different to the matter of voting, but then it would be helpful to hear that recommendation as well. Mr. Zagone, where does this go from here?
Yeah, sure. So when we look at the space, both financial institutions using it, but also the cryptocurrency used at the retail market, when we look at the risk there are no new risk. So there's consumer and investor protection. It's not a new risk. We see that in traditional markets. There's AML, which we see in traditional markets. And there's safety and soundness about the exchanges. Same type of risk we see in traditional payment companies. So our recommendation has been to take the type of rules, the tools regulators have in the market today and apply them to this sector. So to bring that activity into the regulatory fold. So that would include consumer protection, AML, cybersecurity, and capital requirements. Then you're starting to safeguard that activity. We think that is a pretty good way to capture the risk that's there today. Some countries have looked to either ban the technology entirely. We think that is a short-sighted view because the tech does seem to have great potential. I have one quote. Positively, we see firms from using cryptocurrency for international money remittance, lowering the cost and time of sending money overseas. There are legitimate and economically significant use cases. That's from the Financial Conduct Authority in a speech on Friday. And then my last point, there is hope that decentralized applications spurred by crypto assets will lead to a financial ecosystem that is more efficient and more robust in resisting threats. Christine Lagarde, Managing Director of the IMF, at the spring meetings 2 weeks ago in DC. There's a lot of potential to the tech. We want to recognize that and make sure that regulation is balanced to both capture the risk we see today, but allows these new use cases to evolve and come forth. We're focusing on trying to strike that good balance there.
Thank you. Mr. Walker, where do we go from here with your red flags?
Oh, for the red flags, I would just urge the committee that we do not repeat the mistakes that have been made over and again of getting blinded by the word innovation, particularly relating to financial products. I know regulators have a very hard job to do, especially keeping up. Mrs. Walker used to be a regulator, and they're good people who work very hard. But when you get red flags right at the beginning of particular, where you've got a combination of technology and finance, we have to pay attention to those red flags right up front. We've had almost 10 years of Bitcoin now, and that would be the main thing I have to say. Don't get blinded by the word innovation. Innovation is a neutral word. Innovations can be for the good or for the worse, and the most innovative people have often been criminals or people who've been defrauding the little guy.
In your written evidence, you noted that cryptocurrencies and other crypto assets show all the regulatory red flags. What about the underlying technology?
Now, again, underlying technology has diverged in many directions. When it comes to the regulatory approach to that, on one level, if you are using some elements of the blockchain technology, which may even be things which were from 20, 30 years ago, on one level, it shouldn't really matter to the regulators whether using this. It should be immaterial as whether they're using an Oracle database or SQL Server database or programming in C# or Java. But at that level where you want to make sure that these things which are embedded in the FCA rulebook, in the Bank of International Settlements rules on financial market infrastructure, about accountability, stability, etc., that's when they need to take a view on it and actually look at it.
Okay. That's very helpful. Mr. Taylor, I'm not sure the sort of regulators that you deal with. I'm not sure that any business wants more regulation, but do you recognise, are there bits there where you would, or the regulation you want more?
So we don't, as I mentioned before, we don't, as Everledger, engage with digital currencies. So I can't comment on regulation around that.
In terms of the blockchain technology.
But in terms of blockchain technology, we see our, a permissioned ledger is a tool of business, which can have benefits for business, for government, for regulators. I think there is a benefit to blockchain, particularly in the regulation space, with regards to the way that it constructs the immutable audit trail, so that history of transactions can very easily be traced back. I think that's a huge benefit for regulators, not only in the financial industry.
Thank you very much. Dr. Kotsialou.
Regarding cryptocurrencies, I would say that we shouldn't stop it because they bring something new in the world about currencies with no national borders. But it's true, and I totally agree that there are good and bad people involved in that. However, I would suggest to have to regulate them because it would be good in the long term. If taxes will come and regulations, probably, the price of many of those would go down because many people will live out of it, but then you will keep more good and the innovative people. So regarding the technology by itself, I would suggest to have more friendly regulations for blockchain companies. However, again, because there is a lot of hype regarding this technology, there are many companies that they use in the minimum blockchain and they advertise it in another way. So I would suggest to ask the companies to explicitly state in what way they use the blockchain technology. And last, I would suggest to set up interdisciplinary working groups regarding regulations and also other use cases. So, because it's a new topic and you need computer scientists, economists, political scientists, so I would suggest interdisciplinary working groups around it.
Well, that's absolutely fascinating. Can I thank you all very much indeed for your generosity in being here this morning. Your evidence has been, all of it, extremely interesting. If there is anything, having given evidence this morning, you think of anything you wanted to add or to correct, then please feel free to write to the committee. But for now, we're very grateful to you for being here. Thank you.
The proceeding has ended.